Today, we are talking about acquisitions, how to grow your company through acquisitions from someone who's done it many times before. In fact, over 15 times. My guest today is John Bly. He, as I said, has done over a dozen acquisitions. We're going to break them down for you, and I'll tell you more about him in a moment, so stay tuned.
Welcome to the Smart Business Revolution podcast, where we feature top entrepreneurs, business leaders, and thought leaders and ask them how they built key relationships to get where they are today. Now, let's get started with the show.
All right, welcome everyone. John Corcoran here. I'm the host of this show, and I feel so privileged to have great conversations with people that I respect and admire and I'm curious about. And today is no exception. Of course, check out our archives. We've got some great interviews with CEOs, founders, and entrepreneurs, companies ranging from Netflix to Kinko's, YPO, EO, Activation Blizzard, Lending Tree, Grubhub, you name it, Redfin. They're all in the archives. Go check it out. And of course, this episode brought to you by Rise 25, where we help B2B businesses to get clients, referrals, and strategic partnerships with done-for-you podcasts and content marketing. And you can learn all about what we do at rise25.com. And my guest here today, first of all, before I introduce you, John, another John introduced us. So Jonathan Twombly, who's another past guest on my podcast just recently. So check out his archive. He was kind enough to recommend you. And John Bly, our guest here today, is a longtime entrepreneur, and he's currently a member of the board of directors of a large financial consulting and CPA firm called Aprio. But prior to that, he was a CPA who started his own firm shortly after graduating from school. And that was back in 2004, put a lot of effort into it. And through about 15 different acquisitions, ended up growing it to about 70 different people. And then merged with this company, Aprio, which now has about 2,000 people working for it. So an amazing success story, an amazing ride. He's also the author of Cracking the Code, an entrepreneur's guide to growing your business through mergers and acquisitions for pennies on the dollar. And he also is the host of the Aprio Advisory podcast, living in Charlotte, North Carolina. And John, such a pleasure to have you here today. And I love to ask people about even the CPAs, even the lawyers. I asked them this question. When you were a kid, what were you like? Were you out there doing newspaper routes? Were you doing lemonade stands? And you've got some great stories about buying candy and reselling it, pizza and reselling it. I love this.
Yeah, so it's thanks for having me, John. I'm excited to share with your guests. It's one of those things that actually didn't resonate with me until I wrote the book. I was in my early 30s when I wrote the book, and I was writing it, and it was very cathartic. And I called my parents, and I'm like, I've had this awakening that I was an entrepreneur from a little kid, as I had to tell these stories. And they're like, "Yeah, we knew that." I'm like, "Well, why didn't anybody tell me? Like, how did I get into my 30s before I realized, this was a thing?" So yes, I used to sell candy at school. I used to buy it at the local gas station in bulk and then resell it during the day because kids wanted snacks. I used to be sent to overnight camp. This one time I went to a golf camp at Cornell overnight for 5 days. My parents sent me with 500. I came home with over 1,000. No gambling. I would go around door to door and ask if anybody wanted pizza. Nobody wanted pizza. So I would order 8 large pizzas. Then everybody wanted pizza as soon as it arrived. And so I'd resell it for $2 or $3 a slice. I did that throughout my life as a kid. I also had a paper route. So I started with 60 papers and woke up at 4:45 a.m. By the time I was done, because people kept quitting around me and I was really good at it, I had a cycle down on how to collect. I left the bills in their mailbox at 4:45 a.m. I picked it up the next day, the payment. Very rarely did I have to go collect. And by the time I got through high school, I had over 550 papers I was delivering every morning at 4:45 a.m. And
how do you possibly deliver on your bike or
bike
in a
or car? Yeah, at
bike
some points car. I got to a car. Yeah, what about the time I was 16?
That's a lot of houses.
It was a lot. I was running from door to door. This is before you used to get to put it in people's mailbox, right? This is 30 years ago. And so got to actually put it between the door slot, between like a screened in door, the worst, which is why I live in Charlotte, North Carolina. I'm from Albany, New York. And we would get a lot of snow. And I'd be the first one.
You're doing this in Albany, New York. Oh, brutal.
I'd be the first one to cut through the snow. If we got 12 inches overnight at 4:45 a.m., I'd be the first one. It would take me the days that we would get more than 6 inches of snow. I was always late to school because it would add an extra hour to my morning.
Oh, jeez, that's brutal. That's brutal. I don't know how you do that, getting up in the freezing cold weather. Another interesting thing, though, about you, just as an observation here, you end up you kind of going into a vocation, kind of like I did. I became a lawyer, not a practicing lawyer anymore. You end up studying accounting and becoming CPA, and yet there's this other element. I'll call it other element of your personality. That's a little more freewheeling, because entrepreneurship is a little bit more gray area than the cut and dried world of joining a vocation. What are your reflections on that? The fact that you were drawn to a vocation, and yet you also have these elements of your personality that are drawn to entrepreneurship.
Yeah, it's interesting. And now I have teenagers, so I reflect a lot on this as I think through what they're going to do in life. And, I graduated from high school in the 90s, and there was not, at the time that I'm aware of, a degree called entrepreneurship. I didn't even know it existed. And I grew up around people who all had W-2 jobs. It wasn't until college that most of my college roommates, their parents were entrepreneurs. They actually owned businesses. We didn't call them entrepreneurs at that point. We called them business owners, but they all owned businesses. And that's really when I realized that there was something else out there than just, getting a W-2 job. Had I graduated 10 years later, I probably would have had a degree in something other than the accounting profession. I love what I do, but it would have been probably different.
Yeah. And you actually, almost right out of school, end up starting your own CPA practice with your wife, who's also a CPA, which I would say, depending on the market you're in, is not a typical thing to do. A lot of times, in these vocations, whether it's dentist, lawyer, CPA, accountant, whatever, you go and work for another company, learn it for a bunch of years, and then maybe 10 years in, you start your own company. So what was that like in the early days, starting your own company with not being that long out of school?
Yeah, I was less than 3 years out of grad school. At the time, it seemed super easy. Now in reflection, I think, what exactly went through my mind at the age of 25 to think this was a good idea? It's worked out 20 years later. So, that's good. But I'm not suggesting a bunch of 25-year-olds quit their jobs and start something. It actually came from a classified ad. No joke. At the back of a trade rag, I was a little bit frustrated with the corporate bureaucracy of, like, everybody sort of gets promoted along the same level at the same time. And that just didn't fit who I was. And so I was reading in the back of the Journal of Accountancy that somebody could buy a CPA firm. I was reading the classified ads and I was like, what? That's a thing? You could buy an accounting firm? And I had no idea. And that got me thinking. That was really, and I sort of studied it for about a year and realized that it was a real thing. And I went through the process to figure out what it would be like to start my own small accounting firm. Because at the time I was at the large accounting firms, the Big Four. And if you've ever been at the Big Four, until you leave, there are really only 5 or 6 accounting firms in the world. You have no idea who the rest of the firms are.
Yeah, a lot of smaller ones. And so you end up, you didn't end up acquiring, right? You ended up starting your own. So you didn't start with an acquisition then, right?
Did not start with an acquisition, but did one very soon after, just to get to what I'll call a core living, right? Like trying to replace salary. So
that's some of the hardest days, is just the very early days, getting clients, getting people to trust you when you barely have a shingle, right? So
it's hard. The first client is really challenging, right? They don't know you, they don't know anything. And so it's really hard, no matter the business model. It doesn't, this is not CPA specific. It's hard to pick up the first clients.
Right. Well, it's hard to do your first acquisition too. So tell me about that. How did you end up doing an acquisition early on?
So it came from, I started tracking these brokers, a handful of brokers who all they did was sell. And there are still about 5 of them, and I'm still friends with them. One of them, John, is an EO Charleston member, a guy by the name of Brandon Poe, who I actually bought my first practice from. He was not in EO at the time, and neither was I. I didn't even know what it was. But we did a deal together. We still laugh about it now because I see him fairly regularly 20 years later. And literally was checking websites regularly to see what deals might be available. These 5 different brokers who that's all they did was sell accounting firms, and ran across one that was less than 3 miles from my house. And I was like, ooh, this is interesting. that really, started to build some momentum. And so within 60 or 90 days of starting our practice, we were able to quickly acquire a really small one.
Yeah.
Less than
So I'm
100,000
assuming
in
this
revenue.
is like one person, one guy,
Yes.
basically. So you're basically
Yes.
buying their clients probably, right?
For sure.
Yeah.
Yes.
Yeah. And what were kind of the highs and lows of that? How did you finance it? Was it something that was financed over time?
So my dad at the time, it was less than 100,000. My dad actually wrote me a check, and I paid my dad back over 2 years. And it was less than 100,000. Yeah.
Yeah.
And I was 25 years old. I didn't have a ton of liquidity.
Yeah.
All that money I saved from the paper route, I used on the down payment of my house, my wedding, and my engagement ring. And then
and then it was all spent.
And then it was gone.
Yeah. And so you end up acquiring, this small, you get kind of a taste of it, and you're doing 15 after that. So clearly you liked it. What were the next acquisitions after that?
So we did 2 in late 2004, and then 1 in 2005. And at the start of 2006, we were, 300,000 in revenue. They were all really small transactions. And we got the opportunity to do one that was just less than $1 million. And that was a lot to swallow.
Big jump.
That was a lot to swallow.
It's like that, so you're acquiring something that's like 3 times your current size.
Yes.
Yes.
And we followed that.
What were you thinking going into that? I mean, I'm sure your friends you were like, you're nuts.
Everybody thought so. Yeah. I mean, there's no doubt. I mean, I think probably besides my parents and my wife, everybody thought I was crazy. But you just sort of, at that time, this was pre-kids, and I was willing to, I had a reasonable head on my shoulder, and I was willing to do whatever work was required. I mean, I didn't care if it was 130 hours a week, whatever it took to build the business for that limited scope of time in your life, I was in. And to top it off, we did this deal in June of 2006 for just shy of $1 million in new revenue. And literally within 30 days, our only competitor within a couple miles decided they were going to sell. And so we had to buy it. So within 90 days, did another 600,000 transactions. So on May 31st of 2006, it was my wife and I working out of our house. On December 1st of 2006, we had almost 20 people and $2 million in revenue.
Wow. So you go from 300,000 to 2 million in 6 months or so. And 20 people working for you.
And we had a baby.
And a baby. Might as well throw that in as well. And I know you said you were averaging something like 3,500 hours a year. For those who haven't billed your time before, that's absolutely insane. But there are certain things that you can't just work your way out of. There's certain mistakes, strategic mistakes, blunders, stuff like that. Looking back on it now, what are a few of those mistakes? I'm sure there must be some that you wish you could have back.
Yeah. And I would say I'm not the type of person that looks back and say, I wish I had him back. What I did was I definitely learned from him so that I didn't make the same mistake again, if that makes sense. So
sure.
The second transaction we did in 2006, I was from a Big Four background. And to this point, we had, even the one we did in June of 2006, we had then closed 4 transactions in less than 24 months. And to me, a CPA was a CPA. They had an ethical standard. They understood tax laws, whatever. And in December of 2006, the transaction we closed, that first month, we had a learning curve of what we walked into was not the same. And we did not do, prior to that, we did not do any diligence on the quality of the work because we assumed a CPA is a CPA is a CPA.
Got it.
We came in and we had a mess on our hands related to the quality of the work.
How did you discover that?
That first week of December of 2006, we walked in and we started getting client calls of, hey, this is an example. I just got another IRS notice. Ex-owner said they took care of it. We got enough of those. We started digging through files and we found over 115 tax notices that had not been dealt with. That's an example. The other thing we found was as we were starting, that was December, obviously, for those of you who know the CPA business, we get really busy starting in the middle of January. So that's not a great time to be behind. And so not only were we behind, we started to review tax returns and start to prepare tax returns in early 2007. And the advice that had been given in every year prior on 3 or 4 very specific issues is totally not allowed. And we had to deliver that news repeatedly to clients. And they're like, but I've been doing this for 10 years and the IRS hasn't caught it, or I didn't know it was illegal, or I didn't know that you couldn't deduct that or whatever. And these are, and it was time after time. And so we had to deliver bad news repeatedly.
And you didn't unwind or you couldn't unwind the acquisition? Were you thinking at any point like, oh, we gotta undo this?
So take it a step further. As a young 20, I guess at that point I was 27-year-old, I not only could not really unwind it, we had signed up for SBA debt on those deals. So we had paid cash and were levered up on SBA debt. So unwinding was not a real option.
So you had to proceed. We had to move forward with it. Yeah. I'm imagining at the same time, you're going from, a $300,000 company where you're doing a lot of the work to now you have to oversee the team. So probably more of your time is spent on managing, less of your time is spent on the actual doing of the work. What was that transition like for you? And were there any learnings out of it?
Yeah. I was just telling this story the other day to somebody, to a small startup firm that I was coaching, that asked for some advice, mentoring advice. And I remember in August of 2006, when I had the first employee quit, and I was like totally like deer in headlights, had no idea. You don't do that at the Big Four. I mean, it's like, we got 200,000 people. Okay, somebody quits, not the end of the world. But when you have, at the time, we were about 10 before we did the second acquisition, 1 out of 10 leaving 3 weeks before a tax deadline, which is September 15th. We were like, oh gosh, this is it. This is really painful. And, looking back, definitely could have, would have done that differently and not has been as panicked. Definitely learned there. And then I would say in 2007, I was lucky enough to find the Entrepreneurs Organization, which significantly helped me learn leadership skills that I would not have built otherwise. And that's when I started to fall back in love with reading and, gaining knowledge, not tax knowledge, but gaining leadership, entrepreneurship, business advice, lessons learned. And had I not found those 2 things, who knows where we end up.
Yeah. No, for sure. Learning is key. That's why we do it all. I want to ask you about, I want to get to asking about some of the, changes you've implemented. Technology has changed so dramatically in your industry. So I want to ask about that. But before we get to that, I do want to ask about, were there any other acquisitions of the 15 that still stand out in your mind, either good or bad?
Yeah. So in 2004, I mean, there's a story for each one, both good and bad, right? I mean,
Sometimes
even the one, even the one that was in 2006 that had those issues, it propelled us forward and I learned a lot, right? And so got a lot better the next bunch of times. Right. I would say in 2012 and 2014, we did a couple deals, and in both of those propelled us to a point. If you've ever read the book No Man's Land by Doug Tatum, there's this, sort of dead space that people struggle to grow through. And that allowed us to grow through that space. And I had recently read the book No Man's Land back then, or had seen him speak. I can't even remember now. And that really was the starting point to say, okay, we've got to get through this as fast as we can. We did a merger of almost equals in 2014, where the managing partner of the other firm, who's still a partner of mine and a longtime friend, a guy by the name of Jeff Gordon, not the race car driver, had totally opposite skills that I had. Mine were more visionary, strategic. Today, you would call this EOS, and you would call it a
visionary,
a visionary, right? And an integrator. And he was definitely more of an integrator. And that combination made us just explode.
Yeah. You mentioned due diligence was one of the challenges. You didn't do much due diligence before. After you had that, I don't know if disastrous is right, that problematic acquisition in 2006, what kind of due diligence did you do after that?
Yeah, so we did diligence on financial data, but we didn't do any diligence on the work product quality prior to that. Now we do work quality product. We sample the largest clients and spend time going through the individual work papers. We go through the files to make sure we understand what the issues might be and are they really up to speed. We also, I would say that 2006, the other lesson I learned was prior to that, we had taken on employees and whatever, it wasn't that big a deal, but the culture fit was not good from the employees we took on in that second deal in 2006. And I then realized we needed to spend more time on culture up front. It's actually why I started the book with my book on mergers and acquisitions with culture, because it became the primary focus of our deals. We didn't even bother getting into any financial numbers whatsoever if we didn't think it was going to be a culture fit. We never even asked for data.
Well, it's interesting too, because back then you said that you were looking locally. You were looking at these other competitors within a radius of you. Now it's kind of become a more global world. I imagine the acquisitions you're doing are less constrained by geography. So unpack that a little bit, the culture piece. What sorts of questions do you ask? How do you figure out if there's a cultural fit?
Yep. So for me, it's still do the same thing. But this is just who I am. It could work different for other people. I like to break bread. I like to have lunch, drinks, or dinner with the other side as a first step. Happy to have a video call and have a chat and learn a little bit for 30 or 45 minutes. But I really like to spend 2 hours or so in person over a meal rather than just in a stuffy conference room. And preferably dinner or drinks as well, because it tends to let everybody relax a little bit more instead of like, okay, we're in a conference room and we're going to have this serious discussion. And even in those discussions, I'm not asking questions about how much money they're making or what their financial data is or how many, whatever. What I try to be very open and transparent about what we do really well and what we don't do well. I would absolutely open the commode and share at a very deep level a lot of our greatness and a lot of our faults. And if I see the other person shutting down or feeling like they don't reciprocate that openness and transparency, but which I will always lead with, they're probably not going to be a fit at the firm. And that's the last time we're going to have drinks. And if I leave that meeting and they have been open and transparent, there still might be a chance we decide not to do anything further because they may have said something that allowed me to understand that they are never going to want to be part of a bigger organization, or that they don't understand what the future of the profession is, or that they don't understand growth and stuff like that. And it's much better finding that out up front than it is after we fall in love with the numbers.
Yeah. I know in flashing forward to today, you've got, you're a member of the board of directors of Aprio. You run, I believe, the Southeast division, 2,000 or so team members there. You're doing large acquisitions now. When we spoke last time, I think there was a $75 million acquisition. I don't know if that's your largest, but what are some of the differences between the small little acquisitions that you did and the large ones? And I'm sure there's many, but pick a few differences between what you do now and maybe similarities between what you did back then.
And we still do a lot of smaller mergers. We've done 5 in the last 6 months that were under $6 million in revenue. So we're not. So we did do a large transaction last year that was 70 plus million. That's more the exception than the norm. Just there aren't that many firms that are that large in the country, in our world. So we have done a lot of smaller ones. The biggest differences, I think, are really around the internal leadership structure at those organizations. Meaning, at a $70+ million firm, they have CFOs and of their own business, not helping clients, but of their own business. They have leadership of HR and learning and development and talent solutions and like well put together, amazing people. That's not always the case. And you know this, having interviewed a lot of entrepreneurs, that's not always the case at a $5 million business. Many times the founder is doing a significant portion of all of those hats. And so the integration is much easier actually at the larger organization than it is at the smaller one, because the leadership teams just, begin to gel and execute. And so that's actually a lot easier than it is to the smaller ones. The smaller ones, though, have a lot of entrepreneurial spirit that, not always, but a lot of times they have a lot of entrepreneurial spirit, which a bigger firm doesn't always have. And so they bring a lot of energy and different things.
Yeah. Were there any other acquisitions of all the ones that you've done, like the one in 2006, where, if you could have a do-over, you would take it?
Yeah, I think there was one in 2009 that we would probably have tweaked or maybe not done again if we had had another chance. It wasn't very large and it worked out just fine. It wasn't a culture issue at all. They were actually culturally perfect. It really was just long-term vision for what they wanted and what we wanted. More than 3 to 5 years was not aligned. But yeah, I mean, it's worked out. Everybody's happy. We're still, friendly and all that, but it's just not something we'd probably redo.
I love to ask how the pandemic affected different businesses. But before we get to that, about 6 months before that, October 2019, you ended up doing your deal with Aprio. At this point, you've got about 70 people working for you. Aprio has about 300, so you go to 400 people or so. What are some highlights from that? And why did you decide? It sounds like at that point, that's kind of you selling. Everything else I think we talked to so far is you acquiring other companies, but that's you selling or merging with a larger company.
Yeah, so we always built 5-year plans. Thinking about where we were going to be, and we kept doubling in size about every 5 years. And so we were about 12 million in revenue, 70 people, and we looked at what the math would look like and what the team would look like as we fast forwarded over the next 5 years in that summer of 2019. And we had a strong relationship with Aprio at the time. Richard Kopelman, our CEO, and I have been friends for now almost a decade. So we already knew each other. Our clients, we shared some clients on different projects. So some of our people and teams had worked together on some various things. And we looked and we said, look, here's what it's going to take for us to go over the next 5 years to get to where we need to be. Even then, we might fall behind competitors who are larger than us, even though we normally would chase them down, just because of the amount of technology. You said it a few minutes ago, just amount of the technology revolution that we believed was happening in the profession and was going to continue to happen.
Yeah. And so talk about that. Like, how is technology playing a role today compared to 15 years ago?
Oh, it's drastically different. I mean, from everything from gathering of client data to how we push the final results out to them, whether it's a consulting engagement, whether it's a tax return, whether it's audited financials. We now automate a lot of the package solution on the way that they send it to us. We get a lot of data electronically. You rewind 15 years ago or whatever, 19 years ago when I started, nobody was sending us electronic data, or very few were at the small business size. Also, QuickBooks Desktop was the dominant thing in the small business space. Most use QuickBooks Online now. I now have regular access to their QuickBooks every single day if I wanted it. If they say, hey, can you log in and can you check this transaction out, or can you see how we're doing year to date? That was a process before. That was hard to do. They used to give us flash drives, right? And then they'd have to upload, and it's just a pain. Now, all of that is really seamless. Never mind the automation of some bank statements that can come into QuickBooks, and then how we can potentially use that to populate tax returns. I mean, it's a drastic difference. We're using AI and bots and all sorts of stuff for dashboard creation for our clients.
Yeah. It sounds like you're have a positive view of technology. I know many in the CPA profession and in other professions are very resistant. They're fearful. They're fearful that it's going to take away their livelihood, that that they're going to be able to charge less, or that what they do is going to go away. Why do you think you have a positive view on technology? And at least from hearing what you just said, it doesn't sound like you're fearful of new technology, new software coming in and replacing what you do.
That's a great question. I think I'm a person that likes to look back at the history of our profession and also ask people who were smarter, who are still smarter than me, but also started way before me. And, it's not that long ago that in our profession, less than 50 years for sure, that people thought who weren't paying attention, that computers would end the accounting profession, right? And they thought, and instead it hasn't. It's actually leapfrogged it in a positive way. It's not very long ago in the grand scheme of a profession that people were handwriting their general ledgers. And then we've found ways to computer, whether it's Excel or whether it's QuickBooks Online or whether it's, some SAP software, a million places. The reality is that just means better data, quicker, more real-time data for us to be able to be advisory and provide some input to help make better decisions. And that just didn't exist not that long ago, right? And so if you're proactive and paying attention to what's happening in the world and the industry, you're going to be able to adapt. And yes, you might lose this slice of revenue, but you're going to do this other piece that's probably a lot more fun and a lot more value add to the client anyway. We're not handwriting debits and credits like we were in the 70s and 80s. And we're not charging clients less, and clients want us more than they did in the 70s and 80s.
It's an interesting point. Yeah. I'm curious. So you are your title now is managing partner of the South Atlantic in a 2,000 person organization. Going back almost 20 years ago, it was you were the boss. You were acquiring these smaller companies. Eventually you had 70 people working for you. A lot of the people that I interview, frankly, can't handle that kind of transition. And they get to a point where they decide it's not for them. Why do you think that you managed to continue on working in this larger organization and were able to exist in a much smaller organization and also in a larger organization, if that makes sense?
It does. And you're right. I have a lot of clients that can't, had one today, EO friend who's going to exit.
They become miserable, right? They decide, this is not for me. I'm a cog in the machine now. I used to have all this authority. I liked running my own shop. Now I have all these rules and red tape. There's a million different things they say.
Yep, there is. And so for me, I don't know that I could go back and do what I did again in 2004 to 2012. I mean, it was a lot of work, and what we built, I'm very proud of, but I don't know that I'd want to start over and do it the same way I did, 19 years ago today. What helps is that Richard Kopelman and I and our firms interacted so much from 2014 or 15 to 2019 that we went in very much eyes wide open. I mean, not hiding anything. We knew what we were getting ourselves into. Richard knew what he was getting himself into with adding me, and I knew what I was getting myself into. So that helped a lot. I would say the other thing is I have always been all about the team, even as the decision maker, CEO of my own business. I've always been about the team. I've always been willing to sacrifice for the greater good of the 70 people. Today, it's for the greater good of the 2,000. So I'm not the person who, sort of had this, I have to make every decision mentality. I gave up decision making for things under $10,000 as an example in a written policy when we were 4 million. I just didn't want to make those decisions because I was like, we're gonna move so fast that if I have to make every $5,000 decision, we have different problems. And so I was okay with that back then. And my philosophy, even at home, which drives my wife crazy, is I'm okay being on the outside of a decision. Like if I'm not needed, I'm totally good with that. But when I'm part of a decision, this is still the case. My input better be valued very highly, and it would be unusual that I would want that decision to go against the value of my input. But I'm happy if you make 100 decisions without me involved, I'm totally good with it. I don't care. But the minute you ask for my opinion and I weigh in heavily and I've thought about it, if we go a different direction, it's not. That's where that's where I'm not as excited.
I think they know when not to invite Dad into the discussion. Let's just make a decision while he's in the other room.
And I'm totally fine with that, right? Yeah.
I think they know how to manipulate that one. Well, this has been great, John. I love to wrap up with a question about gratitude. I'm a big fan of gratitude and expressing gratitude, especially to those who've helped you along the way in your journey. And so if you look back at, peers, contemporaries, mentors, business partners, who would you want to shout out and thank publicly?
Yeah, so there's a guy dating back to the late 2000s, all the way up till about 2015, who was a personal mentor, a guy by the name of Tom Waddell out of New York, not New York City, but the rest of New York, who ran a CPA firm that I really admired. He's since retired. But I remember calling him in 2012, and we saw each other at a networking group every 6 months. And I remember calling him in 2012 and saying, "Hey, I want you to mentor me for free. I'll fly to you every 6 months, and I'll pay for your flights to fly to me, and I'll pay for golf and drinks and food and whatever. But I want you to spend, roughly 36 hours with me every 6 months, because I'm going from a size that I'm familiar with to a size I'm unfamiliar with, and you were 15 years ahead of me, 20 years ahead of me in this process. Walk me through it." And boy, the lessons I learned from him and were quite incredible.
Yeah, that's great. It's great when you have someone like that who's willing to devote the time. John, this has been great. Where can people go to learn more about you, the book, the podcast, and Aprio?
Yep. So I'm pretty active on Twitter at John Bly CPA. I'm also active on LinkedIn, and feel free to email me if you're interested in learning more. I'm happy to always get on the phone and talk to other entrepreneurs. It's john.bly, B-L-Y, at aprio.com. It's APRIO.
Thanks so much, John.
Thank you, John.
Thanks for listening to the Smart Business Revolution podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.